All right, today we are diving into a real titan of the luxury world, Maltai. We're going to take a look at a Goldman Sachs analyst report to see what the pros are saying. And you know what? The story here, it's a lot more complicated than you might think at first glance.
So first things first, let's just wrap our heads around the sheer scale here.茅isn't just some popular liquor. No, it is the most valuable liquor company on the entire planet. We're talking a market cap of over $250 billion. I mean, this isn't just a drinks company, right? It's a full-blown global luxury icon.
Okay, so when a company that big drops its quarterly results, you better believe everyone pays attention. Let's start with the official story, the main numbers they reported for Q2 2025.
So on the surface, everything looks pretty solid. Total sales, they grew by 7.3% year over year. And in this kind of crazy global economy, that's a pretty strong number. In fact, it was right on the money with what analysts were expecting. So far, so good.
But here's our first clue that something else is going on under the hood. The net profit, it only grew by 5.2%. And look, anytime you see profit growth lagging behind sales growth, that's like a little red flag for analysts. It's their cue to start asking questions and, dig a little deeper.
And when we do that digging, what do we find? Well, we find that those big headline numbers are actually hiding a really fascinating split in how the company is performing. It's really a tale of two spirits, you could say.
And boom, here it is. This is the divide. On one side, you've got the flagship茅spirits, the super premium, high-status stuff. That part of the business saw its revenue grow by an impressive 11%. But then, you look at their more affordable series spirits, and revenue there actually dropped by 7%. Wild, right?
And this chart, it shows you exactly why the company's total sales still went up. I mean, look at this. The premium茅spirits aren't just a part of the business. For all intents and purposes, they are the business. We're talking a whopping 83% of total sales. So that growth in their core luxury product is more than enough to cover the weakness somewhere else.
And this split isn't just about what they're selling, it's also about how they're selling it. Check this out. Sales through their own direct channels, we're talking their own stores, their own app, are absolutely booming, up 17%. But then you look at the traditional wholesale distributors, almost totally flat, up just 1%. That tells you there's a huge strategic shift happening here. They want to control their own sales. So here's the thing. Revenue and profit, they only ever tell you part of the story. If you really want to get a feel for a company's health, you have to be a bit of a detective. And the best analysts, they hunt for clues about the future, and they often find them buried deep in the cash flow statement.
Okay, let's break down one of the key things they look for. It's called customer advances. Now, I know it sounds super technical, but it's actually really simple. It's just the cash that distributors pay up front for orders they're going to get later on. So you can think of it as a crystal ball, a direct measure of how confident their sellers are about future demand. And this is where things get really interesting. Analysts found a pretty big warning sign here. Those customer advances, they dropped. Actually, they plummeted by 45% year over year. The Goldman report thinks this could be because distributors are feeling a cash crunch, and they tie this weakness right back to those declining series spirits we talked about. It's a real sign of caution out there.
Okay, so let's put all the pieces of the puzzle together, right? We've got booming luxury sales, but the affordable stuff is struggling. We've got a huge shift to selling direct, but a really worrying drop in those prepayments from distributors. It's a real mixed bag. So, what do the experts at Goldman Sachs make of all this? Well, despite all those headwinds and mixed signals, their final verdict is incredibly clear and direct. They say, maintain a buy rating on the stock.
And they're not just saying it, they're putting a number on that confidence. They've set a 12-month price target of 1,742 RMB per share. At the end of the day, it seems they believe that the sheer strength of that core premium brand is what's going to win out. But of course, buyer rating is never a sure thing, right? And the report is really careful to lay out the big risks. We're talking about things like potential new regulations, maybe a tax hike, or a global economy that recovers slower than we hope, which would hit spending. They even mentioned potential volatility from things like U.S. interest rate hikes.
So there you have it. That's our quick financial health check on茅. But when you step back and look at this story, a thriving super premium brand next to a struggling, more affordable one, it really leaves you with a much bigger question to chew on, doesn't it? When a luxury giant's top end soars while its affordable lines falter, what does that really tell us about the health of the global consumer?